Warren Buffett recommends index funds. Financial advisors recommend actively managed funds with high fees. Guess who makes more money off the second option? Not you. Index funds are the most boring, unglamorous investment you can make, and for 90% of people, they're the best choice. This video explains what index funds actually are, why they beat most alternatives, and how to start investing in them today. An index fund is a basket of stocks that tracks a market index. The S&P 500 is an index of the 500 largest U.S. companies. An S&P 500 index fund owns all 500 of those companies in the same proportions as the index. When you buy one share of an S&P 500 index fund, you're buying a tiny piece of Apple, Microsoft, Amazon, Google, and 496 other companies simultaneously. You're not picking winners. You're buying the entire market. That's the whole concept. Most people who try to pick individual stocks lose money, not because they're dumb, because beating the market consistently is nearly impossible. Even professional fund managers with teams of analysts and millions in research budgets fail to beat the market 80% to 90% of the time over 10-year periods. If the experts can't do it, you probably can't either. Index funds don't try to beat the market. They are the market. When the market goes up 10%, your index fund goes up 10%. You'll never outperform, but you'll also never underperform. Actively managed funds charge fees to pay analysts, managers, and marketing. Average expense ratio, 0.5% to 1.5% per year. Index funds are automated. They just track the index. Average expense ratio, 0.03% to 0.2% per year. That difference sounds small. It's not. Example, you invest $10,000. It grows at 8% per year for 30 years. With a 1% fee, you end up with $76,000. With a 0.1% fee, you end up with $94,000. Same investment, same returns. $18,000 difference because of fees. Fees compound against you the same way returns compound for you. When you buy individual stocks, one bad company can destroy your portfolio. Enron, Lehman Brothers, FTX if you count crypto. If 20% of your portfolio was in one company that went to zero, you just lost 20% permanently. Index funds spread risk across hundreds of companies. If one company in the S&P 500 goes bankrupt, it's 0.2% of your holdings. The other 499 companies absorb the loss. You barely notice. This is why index funds are safer than individual stocks for most people. You don't need 10 different funds. You need 1 to 3. S&P 500 index fund tracks the 500 largest U.S. companies. This is the default choice. VOO, Vanguard, SPY, State Street, or IVV, iShares. Expense ratios around 0.03% to 0.09%. Total U.S. stock market index fund tracks every publicly traded U.S. company, not just the largest 500. VTI, Vanguard, or iTote iShares. Slightly more diversified, expense ratio around 0.03%. Total World Stock Market Index Fund tracks companies globally, not just the US. VT, Vanguard, or ACY iShares. Maximum diversification, expense ratio around 0.07%. Pick one. If you can't decide, pick the S&P 500 fund. It's simple and it works. You need a brokerage account. Fidelity, Vanguard, Charles Schwab, all work. Sign up. It takes 10 minutes. Link your bank account, deposit money, search for the fund ticker symbol. VOO for Vanguard S&P 500, VTI for Vanguard Total Market, VT for Vanguard Total World. Buy shares. You can buy fractional shares at most brokers now. You don't need $400 for one full share of VOO. You can invest $50 and buy 0.125 shares. Set up automatic investments if you want to dollar cost average. Done. The best time to buy was 10 years ago. The second best time is today. Trying to time the market, waiting for a crash, waiting for the perfect entry point, usually means you wait forever or you buy at a worse price than if you just started immediately. The data is clear. Time in the market beats timing the market. If you're planning to hold for 10 plus years, the entry point matters way less than the fact that you started. Just buy and hold. If you're a professional trader, have inside knowledge, or genuinely have an edge that lets you consistently beat the market, then active investing makes sense. For everyone else, index funds win. If you enjoy picking stocks as a hobby, fine. Do it with 10% of your portfolio. Put the other 90% in index funds. Treat stock picking like gambling, fun with money you can afford to lose. But your serious retirement money belongs in boring index funds. Index funds are tax efficient. They don't trade much. Buying and selling stocks inside a fund creates taxable events. Active funds trade constantly, generating capital gains taxes you have to pay even if you didn't sell your shares. Index funds only trade when the index changes, which is rare. Lower turnover means lower taxes. Over decades, this saves thousands. The boring approach is also the tax-smart approach. The best place to hold index funds is a Roth IRA. You contribute after-tax money. It grows tax-free. You withdraw it tax-free in retirement. No taxes ever on the gains. If you're young and expect your income to rise, Roth beats traditional IRA. Max contribution in 2026 is $7,000 per year if you're under 50. Open a Roth IRA at Fidelity, Vanguard, or Schwab. Invest in index funds inside the Roth. Let it compound for 30 years. This is the closest thing to a guaranteed wealth-building strategy that exists. Start with whatever you can. $50 a month, $100 a month. The amount matters less than the habit. Consistency beats big one-time investments. If you get a raise, increase your contribution. If you get a bonus, invest a chunk of it. The goal is to build the muscle of regular investing. Over time, your contributions grow, your returns compound. The math works in your favor if you give it enough time. Index funds are not for money you need in 1 year or 5 years. Short term, the market is volatile. It can drop 30% in a year. It can stay flat for 3 years. But over 10-year periods, the S&P 500 has been positive 94% of the time. Historically, over 20-year periods, it's been positive 100% of the time. This is a long-term strategy. If you need the money in 2 years, keep it in a high-yield savings account. If you don't need it for a decade, index funds are the move. Older advice said to hold bonds for stability. Bonds are less volatile than stocks. They provide income. They balance your portfolio. That's still true, but less relevant for young investors. If you're under 40 and investing for retirement, you can handle stock volatility. Your time horizon is 20 to 40 years. You don't need bonds yet. 100% stocks and index funds is fine. As you get older and closer to retirement, add bonds. The rule of thumb, your bond percentage should roughly equal your age. At 30, maybe 10% bonds. At 60, maybe 40% bonds. But early on, stocks only. Some people obsess over rebalancing, selling winners to buy losers to maintain target percentages. If you're holding one index fund, there's nothing to rebalance. If you hold multiple funds and one outperforms, sure, rebalance once a year. But this isn't make or break. The difference between perfect rebalancing and ignoring it is minimal over decades. Don't overcomplicate it. Pick your fund. Keep buying it. Hold forever. Panic selling during crashes. The market drops 20%. You see your portfolio down $5,000. You sell to stop the bleeding. Then the market recovers and you missed the rebound. You locked in losses. This is how people lose money in index funds. The correct move during a crash is to keep buying or do nothing. Crashes are sales. Everything is cheaper. If you were buying at $400 per share, you should be thrilled to buy at $300 per share. This is counterintuitive. It's also how wealth is built. Financial advisors make money from managing your investments. If you put everything in low-fee index funds and never touch it, they can't justify their 1% annual fee. So they recommend actively managed funds, frequent rebalancing, complex strategies. Some of this adds value. Most of it adds fees. For high net worth individuals with complex tax situations, advisors make sense. For most people building wealth, index funds, and discipline beat advisors. Index funds won't make you rich overnight. You won't double your money in a year. You won't have a story about picking the next apple. This is boring, slow, unglamorous, and it works. The people who get rich quick usually lose it just as fast. The people who get rich slowly, consistently investing in index funds for decades, keep it. Boring wins. Comment starting if you're opening your first index fund this month, or already in if you've been investing in index funds for a while. Next video, credit card rewards explained. The $2,000 per year strategy airlines don't want you to know. Subscribe to Cash Stack. Most people start behind. You have YouTube.